If you go back and examine a Federal Reserve document from 1963 titled Automobile Installment Loans at Commercial Banks, you'll notice something striking right away. At that time, most car loans were instead, buyers are paying closer to $50,000. That's an $18,000 difference, about 56% higher than inflation alone would justify. Yes, modern cars are safer, more efficient, and more technologically advanced. That's undeniable. But household incomes didn't increase by 56% in real terms to match that jump. On top of that, essential expenses like housing, food, and fuel have also risen faster than wages, making affordability even tighter. So how did the auto industry respond to the challenge of selling $50,000 vehicles to consumers who can't comfortably afford them? They stretched the loans. This leads us to the second force. Lenders discovered that longer car loans are significantly more profitable. Let's compare two examples. Take a $40,000 car financed at 6% interest over 36 months. The monthly payment comes out to about $1,217, and the total interest paid over the life of the loan is roughly $3,800. Now stretch that same loan to 6 years. The payment drops to about $773 per month, which feels far more manageable. But total interest paid jumps to about $6,399. By extending the loan, the lender earns roughly $2,600 more from the same borrower. Multiply that across millions of car buyers, and the incentive becomes obvious. There's another advantage for banks as well. The longer a loan exists, the more chances there are for missed payments, late fees, and borrowers ending up underwater. Once someone owes more than the car is worth, refinancing becomes difficult, and many people roll negative equity into yet another long-term loan, keeping the cycle going. From a lender's perspective, normalizing longer loan terms means higher profits and more leverage over borrowers. The third and final force is the role of car manufacturers and dealerships. In the US, dealerships rarely talk about the total cost of a car. Instead, the conversation almost always centers on monthly payments. If you watch car commercials, you'll notice the same pattern. Nearly all of them highlight a monthly figure rather than the full price. Imagine a customer who can afford $500 per month. That buyer could purchase a $30,000 car with a 60-month loan, a $35,000 car with a 72-month loan, or a $40,000 car with an 84-month loan. The monthly cost looks the same, but the dealership earns more by selling the more expensive vehicle. Salespeople also benefit because commissions are often tied to the sale price. The incentives across the industry are aligned towards selling higher-priced cars using longer loans, even if that isn't in the buyer's best financial interest. Over time, the industry quietly shifted expectations. 6 and 7 year loans now feel normal, and average new car payments approaching $750 per month are treated as standard, even though historically none of this is normal. To see how extreme this has become, look at a popular auto dealer clip on TikTok. When asked about the highest car payments they've seen, one mentioned $1,200 per month, and another cited $3,700. Those numbers would have been unthinkable decades ago. The current car market only makes this problem worse. During the pandemic pricing surge, millions of buyers paid inflated prices for vehicles. Today, many of them owe far more than their cars are worth. Longer loan terms have amplified this issue. In a previous Evermark finance video, we discussed someone who bought a Tesla Model Y for $72,000 in 2022. 2 years later, he still owed $52,000, while the car's market value had fallen to about $38,000. That's $14,000 in negative equity. If that loan had been 36 months, it would be nearly paid off by now, despite depreciation and price cuts. Instead, the long loan locked him into years of payments while the car's value dropped faster than the balance. This highlights the core risk. Vehicles often depreciate faster than long-term loans are paid down. Shorter loans dramatically reduce the chance of ending up underwater. For example, on a $30,000 car with a 36-month loan, you might owe around $20,000 after 1 year, while the car is still worth $24,000 to $25,000. With a 72-month loan, you could still owe $26,000 after 1 year on a car worth $24,000, already putting you in the red. This is why higher down payments combined with shorter loan terms are so powerful, even though they feel more painful upfront. Before buying any car, it's critical to calculate the real cost of ownership. ownership. Let's walk through an example using a Toyota Camry with a $32,000 sticker price, which is still well below the national average. Assume a 36-month loan with 20% down. That's about $7,000 up front and a $25,000 loan. At a 6.5% interest rate, the monthly payment comes out to roughly $767, and total interest paid is about $2,612. Once you factor in fuel, insurance, and maintenance, total monthly transportation costs approach $1,200. Many people assume that kind of budget should buy a luxury vehicle, but that's a misconception. And it explains why so many drivers appear wealthy while carrying massive debt. After the loan is paid off, ongoing costs still run about $500 per month. Over 6 years, total spending on payments, insurance, fuel, and maintenance adds up to about $61,112. With the car still worth roughly $18,000 at that point, the true cost of ownership over 6 years is around $43,812. A 6-year loan produces similar totals but adds roughly $2,600 more in interest. The biggest difference is freedom. With a 3-year loan, years 4 through 6 come with no car payments. That's $760 per month you can redirect towards savings or investing. Long loans may feel easier month to month, but they keep you financially locked in for much longer. So what should you actually do if you need to buy a car in 2026 or beyond? Here are 5 practical strategies. First, focus on total cost, not the monthly payment. Multiply your monthly transportation budget by 36 or 48 months and subtract your down payment. That number tells you what you can realistically afford. Second, prioritize vehicles with low maintenance and insurance costs. Tools like Edmunds True Cost to Own can help, and shopping insurance providers can often uncover meaningful savings. Third, follow the 24-10 guideline. Put 20% down, finance for no more than 4 years, and keep total transportation costs under 10% of gross income. Fourth, consider buying a vehicle that's 2 to 3 years old. That's often the depreciation sweet spot. Someone else absorbs the largest value drop while you still get a modern, reliable car. Finally, if you're already stuck in a long loan, you have options. Extra principal payments can shorten the loan. Driving the car well beyond the payoff date restores financial flexibility, and refinancing may help if your credit improves or rates fall. What you want to avoid at all costs is rolling negative equity into another long-term loan. In 1963, people paid off their cars and drove them payment-free for years. That's harder in 2026, but it's still possible. If you can stick to a 3 or 4 year loan, you'll be far ahead of the average American who never escapes monthly payments. The auto industry has trained consumers to accept 6, 7, and 8 year loans as normal. They're not, and you don't have to play along. If you found this video helpful, check out our breakdown on car affordability, where we walk through a complete framework for deciding how much car you can truly afford. Thanks for watching Evermark Finance, and I'll see you in the next video.